The billionaires running Wall Street don't actually exist. Every year, the press covers the record-breaking compensation packages, billions distributed to traders and analysts. But while the world is staring at the checks, nobody is looking at the hands signing them. Because the true power isn't in Manhattan. It's running on server racks in a data center in New Jersey. This is the story of the silent coup nobody announced.
Right now, as you watch this, autonomous AI systems control an estimated 60 to 75% of all U.S. equity trading volume. BlackRock's Aladdin platform manages the risk on over $11 trillion in assets across 70 countries. Renaissance Technologies Medallion Fund, the most profitable hedge fund in history with 66% average annual returns before fees, eliminated human trading decisions entirely from its process decades ago. The humans at these firms are still employed. They are just no longer in charge. The machine took the wheel quietly, methodically, and without a press release. Before we go further, you need to understand what you're watching and why it matters to you directly. Your retirement account, pension, your index fund, the price of your groceries, all of it is downstream of markets that are now majority controlled by autonomous systems that nobody fully understands. This video is going to walk you through exactly how this happened in 4 acts. By the end of it, you will understand something that most financial professionals are still pretending isn't true. Act 1. Human latency. In the 1980s, the average trade on the New York Stock Exchange took minutes to execute. A broker received an order, walked to a pit, negotiated with another human, and confirmed the transaction. The entire process operated at the speed of human decision-making, which is to say, slowly. And for most of financial history, that was fine, because every other participant in the market was operating at the same speed. The playing field was level because everyone was equally slow. That ended in 2001. In 2001, the SEC decimalized the stock market, shifting tick sizes from fractions of a dollar to 1 cent. The intention was to reduce trading costs for ordinary investors. The outcome was something nobody predicted. It created a new form of competitive advantage, measured not in analysis quality, but in raw execution speed. Suddenly, the ability to send and receive a trade signal in microseconds, 1/1,000,000th of a second, was worth billions. And humans, whose fastest possible reaction time is measured in hundreds of milliseconds, were structurally disqualified from competing. Cathedral Securities began co-locating servers, placing its computers physically inside the same buildings as stock exchange servers to shave nanoseconds off execution times. Renaissance Technologies started hiring not economists, but mathematicians, physicists, and speech recognition engineers from IBM's research labs. The insight was precise. Financial price patterns look like chains of hidden Markov models, the same mathematical structure that underlies human speech. The market was a language, and these firms were the first to learn to read it faster than anyone else.
By 2010, the gap between the fastest algorithmic traders and the fastest human traders had become so large that it was no longer a competitive disadvantage for humans. It was a structural exclusion. Humans weren't slower at trading. They were playing a different game entirely, one that had already ended. The 2010 flash crash made this visible for the first time. On May 6th, automated trading systems interacted in ways nobody anticipated. $1 trillion in market value disappeared in 15 minutes. Then, just as suddenly, most of it came back. The market had moved in a world humans could barely observe, let alone participate in.
Act 2. How the machines wrote their own rules. The next evolution wasn't about speed, it was about data. Traditional fund managers built investment theses from earnings reports, management interviews, and economic forecasts. The data was public. The analysis was human. The edge, if there was one, came from interpretation. Deep reinforcement learning models changed the data equation entirely. These systems don't start with a hypothesis. They are given a goal, generate alpha, and then iterate through millions of simulated trading scenarios until they identify which actions, under which conditions, produce the best outcomes. They write their own rules, and the rules they write are ones no human analyst would ever think to test.
2 Sigma built models that ingest alternative data, information that has no obvious relationship to financial markets, but contains predictive signal. Satellite imagery of retail parking lots, analyzed weekly, predicts same-store sales before the company reports them. Credit card transaction flows, aggregated anonymously, forecast revenue surprises before earnings calls. Global shipping container routes, tracked in real time, signal supply chain disruptions before any analyst publishes a report. The model doesn't know why these signals work. It knows that they do, and it acts on them weeks before any human can open a spreadsheet. This is the moment the information asymmetry became total. Traditional fund managers were working from the same information everyone else had. The AI models at Renaissance, 2 Sigma, and Citadel were working from information that didn't exist in any report, any database, or any human analytical framework. They had found a layer of reality below the surface of conventional market analysis, and they were trading on it, continuously, invisibly, and at a scale that ordinary investors could not see, access, or respond to. The game was no longer being played on the same field. Act 3. Ghost liquidity. Here is something your brokerage statement will never tell you. When you look at a stock's bid-ask spread and see that there are thousands of shares available to buy or sell at a given price, that is not necessarily true. Much of that apparent liquidity is posted by high-frequency trading algorithms that can cancel and repost their orders in microseconds. It exists in the order book long enough for regulatory purposes. It vanishes before a human can transact against it. This is ghost liquidity. And during a market drop, it is the mechanism that turns a correction into a cascade.
Here's how it works in practice. A moderate negative signal hits the market. A bad jobs report, a geopolitical event, a Fed statement that surprises. Human investors see the drop beginning and decide to sell. But before their sell orders execute, algorithmic market makers who posted the liquidity those human orders were expecting to transact against have already detected the same signal, pulled their bids, and exited their positions. The human investor submits their sell order. The order executes, but at a price much lower than the market showed when they decided to sell. The machine was already gone. The human was selling into a vacuum. In August 2024, the Nikkei fell 12.4% in a single trading day. The immediate trigger was a modest interest rate adjustment by the Bank of Japan. Under normal market conditions, that adjustment would have produced a moderate, orderly decline. Instead, correlated algorithmic responses across dozens of independent funds amplified the signal into a synchronized collapse. Each model detected the same trigger. Each model executed the same directional trade. Each exit accelerated the next one. The liquidity that was supposed to absorb the decline evaporated in the same microsecond it was needed. A $1.8 trillion loss in one session. Act 4. The Convergence Crash. And this brings us to the deepest structural problem in the AI-managed market, one that the industry's own researchers are only now beginning to quantify. When independent AI models are trained on similar alternative datasets, they develop similar internal models of market reality. They identify similar signals, they build similar positions, and when those signals reverse, they exit simultaneously. From the outside, this looks like a market crash. From the inside of the model, it is every fund's algorithm executing its own rational risk management protocol perfectly. Nobody broke a rule. Everybody did exactly what they were supposed to do. The crash was emergent.
A March 2026 research paper from multiple institutions described this as a Red Queen equilibrium. Every firm invests in more AI. aggregate alpha approaches zero as the models converge. The primary output of the AI arms race is not excess returns, but systemic externalities, correlated tail risk, flash crash susceptibility, and reduced market resilience. The paper found that even without explicit coordination, AI systems trained on similar data can implicitly collude by converging on correlated trading strategies. The coordination doesn't require communication. It requires only similarity, which the shared universe of alternative data guarantees.
The Bank of England has identified AI-driven convergence as an emerging systemic concern. So has the European Central Bank. So has the Financial Stability Board. So has the IMF. The regulators see the same pattern. What they do not yet have is a framework for addressing it, because the traditional tools of financial regulation, circuit breakers, position limits, disclosure requirements, were designed for markets where humans were the primary participants. They were not designed for markets where independent AI models can converge on identical positions in the same microsecond and exit them before any regulatory mechanism can respond.
Here is what this means for the person watching this video. You are not trading against other humans. You're not even competing with a fund manager who has better information than you. You are operating in a market where 60 to 75% of the daily volume is generated by systems that have already processed satellite data, shipping routes, credit card transactions, and earnings call tone analysis before the opening bell. Your pension fund is managed by the same systems. Your index fund's price at any given moment reflects the decisions of machines that update their positions thousands of times per second.
The question isn't whether this is good or bad. The question is whether you understand the market you're actually in. Because the one that exists in financial news, the one where brilliant analysts debate valuations and wise investors pick winners, that market largely doesn't exist anymore. What replaced it is more efficient in some ways and more fragile in others. It generates returns until it doesn't. And when it doesn't, it moves faster than any human, any regulator, or any circuit breaker was designed to handle. The silent coup is complete. The machines are running the institution. The humans are still collecting the bonuses.
If this video changed how you see the market, and it should, then the question becomes what you do with that understanding. The answer isn't panic. The answer is architecture. Understanding that you are in a machine-dominated market means understanding which behaviors machines reward and which ones they punish. It means understanding that passive, low-cost, long-horizon strategies are structurally rational in a market where the alpha generation race has become a treadmill that only the machines can run. It means understanding that the most dangerous thing is not knowing any of this and behaving as if the old market still exists.
The trillion-dollar funds didn't lose control in a single dramatic moment. It happened incrementally, one algorithm at a time, one alternative data set at a time, one microsecond advantage at a time. Until one day, the humans were still in the room, but the room was no longer making the decisions. That's how coups work. They don't announce themselves. They simply make the old power structure irrelevant. If you want to understand the other institutions that AI has made irrelevant before anyone noticed, the links are in the description. The pattern is always the same. The structure changes quietly, and suddenly everyone can see it.
Change is inevitable. It is like a cloak sewn to the back of our existence. Subscribe so you always know what's changing and, more importantly, what to do about it. Take care, and I'll see you next week.